Welcome to American Realty Advisors Midyear 2023 Outlook webinar. I'm Jay Butterfield, and I'll be moderating today's presentation. I'm joined by my colleagues, Sabrina Unger, Managing Director and ARA's Head of Research and Strategy, and Eric Cannon, Managing Director and Deputy Portfolio Manager for ARA's Value Add Real Estate Strategies. So we're happy you can join us this morning and hope this webinar will provide you with some insight into the trends impacting private commercial real estate investments that'll be valuable in your decision making. This morning, Sabrina will cover the macroeconomic and capital markets environment and key developments to watch. And then Eric will give us an overview of the real estate sectors and how we view the role of real estate and each of these sectors in the portfolio. Now, hopefully all of you have received a copy of the complete ARA Mid-Year House View. If you haven't, you can contact me or you can access it directly through our website, www.aracapital.com. So Sabrina, you want to kick us off?
Absolutely. Thanks, Jay, and thank you to everyone for joining. Good morning or good afternoon, depending on where you are. I think it's safe to say that volatility and uncertainty continue to be the hallmarks of the current investment backdrop. It seems that for every point for easing inflation, sort of moderating or normalizing job demand, and all of the cases for a soft landing, there seem to be an equal number of points for sticky inflation, an overheated job market, and a recession. So suffice to say, there is a lot to make sense of in today's environment. And so I think to start us off, it just makes the most sense to come out and talk about the scenario that really lies at the core of our outlook, both for the macroeconomy and then ultimately how that filters down into the real estate sectors. And that is that we do believe that the US economy will enter a mild recession near the end of this year. So obviously, what we mean by recession is a contraction in GDP. But why do we think there'll be a recession and why do we think it's mild? I think those are fair questions to ask. So why do we think there will be a recession? We see what's happening with Fed policy. There has been ongoing tightening that's really thrown the banking sector into upheaval. If you remember, just a few months ago, there were a couple banks that were certainly challenged given the higher interest rate environment. And that has really created a situation where banks are now becoming stingier about approving loans. And that's really choking off a key growth fuel for the economy for both businesses and consumers alike. So what we can see here is just the number of banks that believe throughout the end of the year they're going to make it harder to get a loan for things like conventional mortgages and credit cards. So those are things that obviously impact the consumer. Then you can also see some of the loan types that impact businesses and real estate. All of these are becoming harder to come by. And again, that access to credit has really been a key growth fuel. And so with that being choked off, we think that that's certainly going to contribute to a moderation and ultimately our sort of base case for recession. Tightened lending standards also often have the effect of stifling employment growth. So if we sort of think about the relationship between small businesses having access to credit and then hiring, the inverse is also true. So when we have a situation where banks are tightening, as we've seen in recent quarters, employment growth tends to moderate in reaction. And the reality is that the labor market is already showing signs of easing sort of outside of this dynamic. So if we sort of look ahead to some of the leading indicators for job growth, so things like announced layoffs, bankruptcy filings, small business outlook, that's really critical because small businesses are actually the groups that are doing the majority of the hiring in the economy. So when that outlook softens, that suggests that employment growth is really going to moderate. So we have this confluence of factors that suggests we're going to have a moderation or a weakening in the labor market, especially in relation to where we've been throughout 2021 and 2022. So those things combined, we think, are going to contribute to a situation where we have a technical recession. But I did say we said it was going to be mild. So why do we think we're going to have a mild recession? And that really is a function of, the relative strength of the labor market as a starting point, and also the strength of the consumer. So even though we believe labor markets are going to soften, we're starting already to see indications of demand moderating. Consumers, which comprise a lot of economic output, they still have excess savings to really continue to prop them up. So even in the event that there aren't as many new shiny jobs out there that are going to pay them more money, they're sitting on a relatively nice nest egg compared to what they would have had leading into past recessions. This is a large part in due to the policy of responses and stimulus measures that were taken in the pandemic. So households really held on to some of that. And although they're spending it down, they still have more. And we think that's going to prop them up, which will sort of create conditions for a relatively mild recession. So very different to the conditions that we saw heading into the global financial crisis, for example. Now, at this sort of juncture, I always get the question, well, isn't it possible that a recession can be avoided? Do we think the Fed is going to pull off a soft landing? We feel like we've got sort of a unique set of circumstances. Maybe that's possible. Of course, it's always possible that we could have a soft landing, but it's not the most probable scenario. So while we would love to see that upside, we're sort of operating again on this base case that a mild recession is the most likely outcome. And the reality is that the Fed has had sort of a mixed track record when it comes to achieving soft landing, and there's a whole host of different circumstances surrounding different rate hike cycles, of course. But if you sort of look back over time, of the 5 definitively hard landings, so that's the thing we absolutely don't want to see, 2 of them, I think you could say, were sort of outside the realm of Fed policy, but 3 of them were in direct response to really aggressive rate hike cycles. And as you can see, and as I think we all know, we are definitively in an aggressive rate hiking cycle. The Fed didn't raise rates in June. Still remains to be seen whether they will do it in July, though it seems an increasing likelihood that they will. But regardless, we're coming off of 10 consecutive rate hikes. It put the Fed funds rate in a target range of 5 to 5.25%. That is the highest level since August 2007 and marks the fastest rate hike cycle in history. I think it's also important to sort of understand, what it is the Fed is doing and really how it measures and counters inflation. So, effectively, higher rates are countering inflation by sopping up some of the excess cash throughout markets and cooling price growth through lessened competition. So the Fed raises rates, it makes getting access to credit harder, it takes some cash out of the system. If there's less cash floating around, there's less competition and price growth slows. That's sort of the perfect scenario, if you will. And for real estate, this often materializes first in shallower financing options from lenders, including banks, which, as you can see sort of on the right-hand side here, net new real estate loans that were being placed by banks went negative in March and April. We really haven't seen that for quite some time. So again, we now have a situation where banks are tightening their purse strings for all loan types, including real estate. When that takes that cash out of the system, there's inevitably going to be less competition and thus moderation in price growth, or it can go negative. And so what we see is that fewer loans are really softening competition and prices as it relates to real estate. And so you can see that, when greater numbers of banks are saying they're going to tighten lending, you can see there's a corresponding sort of lagged response as it relates to real estate values. And really what we saw is that banks started tightening, call it midpoint of last year. And subsequent to that, we saw the first quarter of negative appreciation in the NCREIF property index. So again, the way that the Fed is using higher rates to pull cash out of the broader economy to slow inflation has a similar effect as it relates to real estate transaction volumes and ultimately price growth, competition, transactions. You can see the parallels here. But another reason that real estate markets, specifically on the transaction side, have been relatively sleepy over the last couple quarters, especially, is just it's much harder to get a sense of where values really sit today. And this is despite what had been a fair amount of dry powder sitting on the sidelines waiting to be allocated to real estate. What you can see is if you follow this really simple flow chart, when lending is available, when banks are lending to real estate, that increases deal flow because more people have access to capital. As you have more access to capital, you're buying more deals. More deals means more data points. And so that's going to give others conviction that what they're buying and at what price is appropriate for that asset. The inverse is also true, and that's really where we sit today, which is obviously there is less lending available for real estate. That has really slowed down the amount of deals that can be done. There are fewer data points, and so it's much harder when a deal comes up to determine, is this the appropriate price, or is this something anomalous that has to do with this individual asset, such that I can't make inferences about the broader market, the broader sector, and that uncertainty keeps markets frozen. So it's cloudier to get a real handle, and that keeps transaction volume sort of frozen in place until some clarity comes through. Now, all that to say, there is some encouraging news as it relates to the outlook. And really, what we've been talking about largely has already transpired. So looking ahead, where do we think values are going? That's really one of the most important questions today. And what we did is we took a look at appreciation returns sort of before and after previous peak Fed rates. So essentially in every rate hiking cycle, once we were at the peak, what did appreciation do in the quarters before? And more importantly, what did it do afterwards? And what we saw is that over the last 7 rate hike cycles, so effectively every rate hike cycle that we have real estate appreciation data for, we saw that values were higher 4 quarters after the peak, 86% of the time. So effectively almost 90% of the time, once we've hit peak rates, you can anticipate that values are likely to be higher 12 months from now. Now, 90% is not 100%, and obviously history doesn't always repeat itself, but certainly an 86% hit rate feels like a pretty good place to be. And so we're really optimistic about what that suggests for values going forward in the subsequent quarters. But we know that each sector's propensity to achieve that is going to be very different, and it's really a function of the fundamental drivers. So that data is for the NCREIF property index that's encompassing all property types. We know that certain sectors have a stronger outlook than others. Some of them are still benefiting from some tailwinds, others are battling through headwinds. And so the percentage of what's going to happen 4 quarters from now in values is largely still going to be a function of fundamental drivers. And so with that in mind, to walk us through some of those, I'm going to hand it over to Eric.
Thank you, Sabrina, for that overview of the macroeconomy and capital markets conditions. And thank you, everyone, for joining us on today's webinar. We're going to turn your attention now to our outlook on the property markets. And as far as sector selection goes, we do continue to favor the industrial, rental residential, and select specialty sectors. Our rationale for this is driven by demand for the real estate itself, with our belief in better rent and cash flow growth prospects for these particular sectors. Despite the macroeconomic uncertainty and capital markets headwinds Sabrina just outlined for you moments ago, the good news for commercial real estate, really across all sectors, is that we're seeing supply pipelines for new construction dramatically falling. And we believe this bodes well for fundamentals and a potential reacceleration of rent growth in the medium term as economic and capital market conditions improve. We're going to speak first in terms of sectors on the recently high-performing industrial sector. And as far as demand goes, firstly, we continue to expect demand to be driven by increased customer usage of online shopping or e-commerce. You all, I'm sure, have family and friends like this, but just as one example, my 76-year-old mother had never bought anything online pre-COVID and now regularly shops online and receives direct deliveries to her home from the likes of Target, Amazon, and other stores. Secondly, we've seen industrial tenants keeping more products stocked in warehouses than they did pre-COVID, which creates the need for more space. You can all remember, I'm sure, the very frustrating shortages that we all experienced of many different types of goods and products back in 2020 due to supply chain disruptions. And so it makes good business sense for these industrial tenants to keep more product on hand to meet customer demand. Now, looking at supply and demand in the industrial sector specifically, after seeing supply fall short of demand from all of 2021 and a good portion of 2022, new industrial supply has outpaced absorption in the last 2 quarters. On the other hand, going back to supply pipelines reducing, we saw an 18% year-over-year decline in new construction starts in the fourth quarter of 2022, and a 38% year-over-year decline in new starts for the first quarter of 2023. So consistent with Sabrina's earlier commentary about credit market conditions, developers simply cannot move projects forward without debt capital, and there's very little of it available right now to fund construction. So we've definitely seen increased competition from supply, but that supply is nuanced market by market. Not all markets are created equal, and it does take granular market by market, submarket by submarket level research to identify the markets and submarkets we believe are better positioned than others. And the takeaway from this chart with the 4 quadrants is that we're focused on industrial markets that have some combination of below trend vacancy combined with less available space under construction or less speculative development. Moving on from industrial to the residential sector, as far as demand goes, we expect demand to continue to be driven by demographics, an undersupply of housing, and a challenging home ownership affordability picture. On housing affordability, as you can see demonstrated, incomes have grown less than housing prices and mortgage rates, making home ownership very difficult and providing a tailwind for both apartments and single-family rentals. Think of someone you know in perhaps their late 20s or early 30s trying to buy a starter home right now. It's incredibly difficult. Home builders haven't built any starter homes. There's no supply of them from sellers. Buyers may not have the down payment or income to support a more expensive home, given how high mortgage rates are currently. They may still be paying off student loans. They could be skittish from seeing family members lose home equity during the 2008 downturn. So what are they all doing? They're largely renting, and that's providing a demand tailwind for apartments and single-family rental. Similar to the industrial sector, though, things are quite different market by market, and you can see a wide affordability gap market by market. And this chart looks at housing costs and the percentage of income required to own a medium-priced home in each market. And as we know, many homeowners would be seeking homes much more expensive than your average or median-priced home. And as we can see, the coastal gateway markets still remain the most expensive housing markets to own in. One market I'd just call your attention to here is that over the last several years, we've seen a substantial movement in becoming less affordable is Miami, which is now actually on par with New York City in terms of affordability or percentage of income required to own a house in that market. Similar to the industrial sector, we are seeing supply moderation forthcoming. And we saw multifamily deliveries at a 35-year high in 2021 and 2022. And as a result of that, we have seen multifamily rent growth moderate year over year. But rent growth has the potential to reaccelerate, as we talked about earlier, in the medium term due to curtailed supply. And you can see new multifamily housing permits, they're estimated to drop by approximately 23% this year and more than 20% next year as well. We're going to move on from residential now to the U.S. media's favorite sector to talk about, You all see the new article or business news video online every day. The US office sector, clearly since 2021, we've witnessed constantly changing return to the office requirements from many companies in the US. But we've also seen studies showing decreased productivity and increased employee turnover for remote work. So as a result of that, a consensus does seem to be building around some degree of hybrid in-office and remote work, perhaps 3 or 4 days in the office with the remainder work from home. And you all can see this, I'm sure, playing out in real life during the middle of the week as you're visiting a large city or even a busy suburb. And it's just, there's incredibly more traffic, parking lots are full, and just the office properties themselves are much denser with worker populations noticeably higher midweek. As it relates to the office sector, not all office is created equal, however, and we've seen and expect to continue to see a large bifurcation between the performance of top tier office assets and the remainder of the market in terms of both occupancy and their ability to attract high quality tenancy. We continue to expect this relative outperformance for the newer modern buildings going forward. And to conclude on office, we are maintaining a very cautious approach due to the uncertainty of demand, but primarily because of the relatively higher capital costs associated with leasing office space as compared to the other property sectors. And turning now to the retail sector, this is really interesting because back in 2020, the US media was predicting a retail real estate apocalypse, sort of similar to what they're doing today with office. And you can all remember the commentary, no one's ever going to shop in a bricks and mortar retail store again. Online is the sole future for shopping, etc. And while there was indeed a culling of weaker properties, think Class B malls or perhaps not well located big box power centers, the media was largely wrong on retail. And it turns out people actually do like to go into a store to browse, buy groceries for quality control, try out a product in person, try on an article of clothing in person before just buying it and having to return it if it doesn't fit properly. So the post-COVID boom in consumption has resulted in strong retail sales, which could moderate in a recession a bit. But as Sabrina touched on earlier, consumer balance sheets remain strong and much better positioned heading into this potential downturn than they were pre-GFC. We've seen outperformance specifically on retail by service-oriented or grocery-anchored retail. Think stores that are less exposed to online shopping, such as convenience coffee shops, nail salons, hair salons, quick service food, etc. And we expect that performance to continue to be strong. Now, to finish up the sectors, we're going to talk about the ever-growing importance of specialty sectors. And we continue to be attracted to certain specialty sectors, specifically single-family rental, self-storage facilities, and data centers. And we're attracted to them because of their strong NOI growth forecasts. As it relates to single-family rental, millennials are simply renting longer. And as we took you through moments ago, many cannot afford a home down payment or mortgage, and yet they want more space than they can get available to them in a small apartment. So we believe SFR is a nice product to meet this growing segment of demand. As it relates to data centers and self-storage, we like them for their defensive nature with a low correlation to overall macroeconomic conditions or the business cycle. And we continue to see increased liquidity toward specialty sectors from institutional portfolios, largely driven by reallocations away from office and retail exposures to these sectors. So what does all this mean now that Sabrina's taken you through the macroeconomy and capital markets overview, and we've recently discussed the property sectors? What are the implications of our mid-year outlook for portfolio management and portfolio construction? Well, it really is a time to roll up your shirt sleeves and be very hands-on aggressively asset managing properties, to lease vacant space, efficiently manage expenses down where possible, and scrutinize CapEx decisions for return on investment. We'll continue to execute on appropriately sized dispositions where we've completed business plans or foresee limited remaining upside in assets. And you can expect these to generally be smaller to medium-sized single asset dispositions as opposed to large portfolio sales where there's less liquidity and less buyers in the market today. On the new investment front, we're seeking to be a liquidity provider to resolve debt-driven maturity issues. And importantly, we're focused on good assets with bad capital structures, not bad assets that have weak underlying demand drivers. You've all seen it, but there's approximately $900 billion of maturing commercial real estate loans over the next couple of years. So we see ample opportunities to be a liquidity provider in that situation. We're also looking for below replacement cost acquisition opportunities in residential and industrial. These are assets that can be acquired today for less than the cost to develop them. And we are selectively targeting new development opportunities in tight submarkets that have the potential to deliver during a period of more limited supply in 2024 and 2025. Now, to conclude our webinar today, Sabrina and I are going to bring back in our colleague Jay Butterfield to lead a brief question and answer session.
Great. Thank you very much, Eric and Sabrina. We had some questions that were submitted ahead of time by our participants, and not surprising, a number of them deal with the office sector. So I'll try to summarize these. And you touched on the office environment earlier, but can you give us a sense of the near and medium-term challenges for office? And I think most important, have we seen values written down enough to date?
Yeah, I think in my view, sort of the near-term challenge is one that we've been facing for a couple of years now, right? Which is, how do we get more people into the office more consistently? And how does a recession play into that? And I think you can argue both sides, right? I think on the one hand, there is a view that a recession that triggers a higher unemployment level could put the balance of power back in the employer's hands, and they can mandate more days in the office, for example. But on the other hand, if we're going to see an increase in unemployment such that the shift in power really overcomes some of the structural demographic limitations to the labor force today, if we see unemployment increase that much, are companies going to sort of use that balance of power to call people back to the office, or are they going to be scrutinizing their business growth prospects and maybe looking for opportunities to save on costs? And obviously office is one of the places that they might be able to do that. So I really think near-term challenge is how are businesses going to navigate a recession, and what will that mean for bringing people back? In terms of values, just generally, obviously it varies market by market and by asset quality, as Eric alluded to, but values are down something like 30% from recent peak. If you look to sort of the consensus, what folks are expecting for values in office for this year, the latest consensus forecast suggested a cumulative, call it 18% value decline in 2023 and another 6.5% value decline next year. So depending on where you fall in this recession shift of power debate, that might be a little optimistic. But if you look what's trading, again, not much is trading, and so there's these very anomalous sort of deals, but some of those are trading at 50% discounts to the last acquisition price. So it still seems like there's a ways to go, especially for specific assets and specific markets.
The only thing I'd add to Sabrina's comments, Jay, as it relates to office valuations within our own fund portfolios, we've gone back and looked at appreciation in property values for office holdings from 1Q 2020, which is pre-COVID, to 1Q 2023, and compared that to the Odyssey Index. And we feel as though we've been out ahead of the peers in terms of the recognition of value adjustments.
Well, now more generally, everybody wants to know when we can see a more normal level of transaction activity. I mean, when are buyers and sellers going to be coming back to the market so we can maybe see some validation of those valuations?
Yeah, I think we think back to that very simplistic sort of flow chart. We'll see greater transaction activity when there's greater certainty around rate trajectory and when some of the liquidity sources come back to the market. So I think markets can adjust. The real estate market can adjust to higher level of stasis for interest rates. I don't think any of us believe that we're going to go back to a zero interest rate environment, at least not for a good long while. So we can adjust to higher rates, but what is more challenging is not understanding, at what point will we hit sort of the peak rate, and how long will it take for some of those liquidity sources like banks to come back. So let's assume that we reach peak Fed funds rate in the third quarter. I would expect transaction volumes to start to resume shortly thereafter and more fully come back in 2024. We're already starting to see more groups making more offers and closing more transactions just in the last couple months relative to what we had really seen occurring in the last 3 quarters. So people are starting to get their feet under them, and I think by year end and certainly heading into next year, we should see a return to relatively normal transaction volumes.
And when that transaction activity resumes, so what sectors are more likely to lead the resumption?
Well, you'll continue to read more press and headlines about the distressed office loan sales and transactions, but the reality is we think the volumes will continue to be led by the industrial and residential sectors, with specialty sectors close behind. On industrial, we've already seen an increase in investor bidding activity, as Sabrina said, just in the last couple of months, on acquisition opportunities, and not just from private or high net worth capital, but from public REITs as well as institutions. And we've seen this on single industrial assets that we're divesting of from our own fund portfolios, as well as we saw a very recent large portfolio trade to a public REIT at a 4% cap rate. On the multifamily side, we think the acquisition transactions are going to be driven by maturing loans and sellers not liking the refinancing profile of what a new loan would look like in this credit market environment.
So we've heard a lot of news about cities and the challenges to urban markets facing the post-pandemic world. So how does this recovery look for urban versus suburban markets in terms of demand from investors and also from potential tenants?
I would say that cities are not dead, and they're still very much desirable for young professionals to live, work, and play in particular recent college graduates. And as it relates to the sectors in the large cities, gateway office, as we said earlier, is going to continue to be a tale of the top tier assets versus the rest of the market, and that continued relative outperformance. As we demonstrated earlier on the residential side, these markets are the most difficult markets to own a home in. And so the propensity to rent multifamily housing is much higher. And so there's strong demand for multifamily. And on industrial, we've seen a trend of industrial users seeking to get closer and closer to the consumer. And big cities obviously still have the densest population base, and they're also the hardest to create new supply in due to land costs and land constraints. So we expect strong performance from infill industrial close to major cities.
Yeah, I would say just generally speaking too, when we think about migration and the movement of people that we saw during the pandemic, that was somewhat anomalous. Migration historically has been quite closely linked to job growth. And as we saw with sort of the mass work from home experiment, people were sort of moving to all 4 corners of the world and were able to keep their jobs. But as companies start to call people back, as we sort of get into whatever the normal is for office, we do think that there's going to be sort of a mitigation in terms of the outflows from major cities, because those large coastal cities, so places like New York and Los Angeles, they still haven't recovered all of their pandemic job losses, which inherently suggests there are more jobs to be filled, and that should start to call people back. So we do think that from a migration standpoint, there certainly will be the appeal of cities. I think the other piece that maybe people aren't talking about as much or enough is the impact of immigration and what the cutoff of that during the worst of the pandemic really did to dense coastal cities. Again, I'll sort of pick on New York and LA, but those were cities that captured, 11%, 5% of total US immigration in the decade leading up to the pandemic. So when you shut that supply of people off, it disproportionately impacts population growth and job growth in these major urban markets. But as that recovers and is continuing to recover, the major urban cores, I think, will start to continue to see their recovery accelerate.
Yeah, well, what about the demographic trends and movements into, these high growth markets? Like everybody's moving to the Southwest and the Southeast, maybe, because of the weather, although lately maybe in spite of the weather. Is this a longer term trend, and how does that shift the equation overall?
Yeah, I think, our anticipation is that we expect the inflows into a lot of those high growth Sunbelt markets to moderate from the breakneck pace that we have seen over the last couple of years. And I think it almost has to, right? Eric made the point that Miami, the share of your median income that you need to set aside to be able to own a median priced home is on par with New York City. That was never the case, right? And we look to some of these other historically more affordable markets. So I'll choose Orlando, right? We're not talking about a coastal market that's sort of limited geographically by land constraints. To be able to afford a home, your total payment as a share of your median income in November 2020 was 26%. So you're below that 30% income sort of threshold that we think signifies inaffordability. It was 26% in November 2020. Today, the share of median income you need for your total housing payment is something like 45%. So the home prices have just accelerated in such a way in these high growth markets that the affordability component of what was drawing people in may be eroding or at least moderating somewhat. So I do think we're going to see a moderation of the inflows into those markets compared to what we've seen. But the things that were drawing people in, sort of absent the work from home, so lower taxes, higher perceived quality of life, the weather, right? All of those things are still there, but I think the balance of inflows is stabilizing.
So we've received a lot of questions, more than we can address here. But as a final question, if you had $1 to allocate today to real estate, where are you putting it for 2024?
Yeah, I think if I can take my dollar and split it 50 cents and 50 cents, I'm going to put 50 cents into purpose-built single-family rentals and 50 cents into infill industrial. The purpose-built single-family rental story, I think, is really interesting and still feels like we're in early innings when I look at sort of the long-term structural case for that investment class. As Eric alluded to, we have millennials that are having families, want to be in a bigger space, care more about school districts, but either cannot access or may not want to get into the traditional homeownership market. This fills a huge gap for them. So I really like that story. But then even looking further out, thinking about things like multi-generational housing, right? We have a large number of baby boomers that when they inevitably retire, maybe they don't want to go into a traditional senior housing facility. What will millennial children and subsequent generations need as far as space to maybe accommodate multi-generational housing? So I think for a lot of structural reasons, I'm very favorable to single family rentals, purpose-built communities, and then infill industrial for the reasons Eric outlined. It's very hard to come by, even in the event of a recession. If we have a modern new spec building within 10 miles of New York City, an occupier is going to snap that up regardless of the economic backdrop that we're in. And so I think that's how I'd split my dollar.
It's an excellent question, Jay. I'd put a third of it into originating subordinated debt and preferred equity. I think very attractive risk-adjusted return profile right now. You have higher absolute rates of return on these investments given the level of interest rates, lower loan to value in terms of your position in the capital stack, and just generally more conservative assumptions baked into the underwriting. And the remainder, I would target multifamily acquisitions because we haven't seen this for some time, but you can actually buy for a nice discount to replacement cost today in some supply constrained submarkets. And remember, the price you pay for an asset is permanent, but the amount of your debt and cost of that debt is temporary. You can replace it in the future if interest rates decline. You can acquire things unleveraged. So there's a window of buying opportunity, we believe, to take advantage of this reduced pricing driven by elevated interest rates. And lastly, don't forget about grocery anchored retail. Well-located retail real estate we expect to continue to perform well.
Well, thank you, Sabrina and Eric, and thank all of you for attending. Please let us know if you have additional questions. The questions are submitted, we'll follow up on, and obviously you can contact me or directly or through our website. We had a lot of fun doing this. We appreciate your interest and look forward to talking to you more. Thank you very much and have a great day.
Thank you.
Thank you.